guys, it's Henry from IFE. So I want to go over the Fundsmith annual review done by Terry Smith. He does it annually around February each year. This was a bit different. Normally it's a conference event. This year obviously it was a video one. So why am I going this? It's a fund that I hold personally in my portfolio. I listen to quite a few fund reviews from a lot of different companies, particularly like this one, for a number of reasons. And I want to go over the year ahead and what were the main takeaways from it. The video is on YouTube, on their website. If you did want to view it, it's an hour and a half long. I will try and summarise it in a few minutes, so it won't be as detailed as what Terry has gone into. Number one was look for companies with good growth margins. This may sound pretty simplistic, but I think it has remnants this year more than ever due to the stimulus packages that have been put out in developed worlds, particularly Europe and the US. You're looking at inflation going to kick in, and those with good profit margins will still stand to prevail. Second was look for companies with the whole company of it. So one example that Terry touched on was Amazon. Amazon, obviously a great company. A lot of people have it in their portfolios, and even more people hold it in funds or index or ETF trackers within their portfolios, especially as it's a heavy weighting. Broke the business down into two sectors. One was the AWS, Amazon Web Service, and the retail side. Now, the retail side, I'll put a link to in the description below, was actually only made profit 3 years ago, and its profit margins are still quite slim, around 2%, whilst the Amazon Web Service profits are around 20 to 28%. And it was actually holding up the retail side of the business. So that's one of the reasons he stated that he hasn't invested in that. And what for? The other ones touched on specific sectors. So one was oil. Why he's staying away from that, and why potentially you may want to look elsewhere in your portfolio. I actually think a lot of the oil companies are doing a lot of R&D, etc. And it's one of the few sectors that are value as of speaking in 2021. But one he stated was that you're not intrinsically attached to use one oil company. So for example, if you're driving down the road, you don't want to specifically use Shell or BP's oil. You just use whichever one's there. So therefore it's got no kind of value attached to it, the brand in that circumstance. So therefore it's just not feasible for them to invest. One of the other ones was the automotive sector. Now, we said a lot about Tesla in a lot of the articles, how it's overvalued, etc. One of the reasons they haven't gone into it has been that buying a car, you don't buy it as often as you do other products. For example, the profit margins on, say, one of their holdings, L'Oreal, quite high, and obviously you buy a lot of their products mostly every month. Cars are a bit different. You probably buy one every 5 years, and the profit margins are increasing. Also, from it's a bit different. Tesla's market share, it's not the only one in the market. So some of the key takeaways were to look for companies with good profit growth in 2021, look for companies that have a good intrinsic value, and look for the whole company. I'll put a link to the whole kind of annual report. Then I think it's, if anyone's holding it, it is quite interesting. Obviously Terry's a good speaker, so feel free to watch that. Thanks guys, cheers.